Welcome to the Rutgers 6th Annual Private Equity Family Office and Employee Share Ownership Symposium. It is with great pleasure to be the moderator of this panel. The topic of this panel is ESOP company and family office co-investment opportunities. I'm honored to have on the panel Colin Patrick. He's a CPA, Chief Investment Officer for Patterson Thoma, Jim Adams, former partner in a large law firm, board member and advisor to several family offices. Colin, Jim, could you just spend a couple of minutes and give the attendants a snapshot of your background and your role with family offices, please?
Sure. I started my career as a tax accountant with Deloitte. Always worked with high net worth individuals and small businesses, and evolved over time to work directly for a family office with their taxes initially, as taxes often their biggest expense, and really was able to evolve that into portfolio management and portfolio construction as an effective way to manage the after-tax yield of the entire portfolio. So that was kind of started tax, and now we focus on the investing, thinking about taxes.
Great. Jim Adams. I spent a little over the first half of my career practicing law. I did M&A work and private equity work and a lot of just representation of entrepreneurial businesses rather than public companies. And then got lucky enough to get into the family office space, started and ran a family office that was fairly substantial, and then ultimately went to work and reorganized and ran another substantial family office. Stopped working full-time for money a couple of years ago, but am now on family office boards and doing other advisory things.
Thank you. And I'm John Cobra. I'm a partner at Morgan Lewis and spend a significant amount of time with family businesses, family offices, and ESOP transactions. Just to start the stage, Colin and Jim, ESOP companies traditionally have been successful family businesses that have used ESOP structures to transition to family business. And they've created a lot of wealth for the employees. And a lot of people view it as a way to narrow the wealth gap in this country. Many of those ESOP companies are 100% owned by the ESOP and are S Corps, which means they generally pay no tax, they're tax exempt, which gives them a significant benefit to participate in investment opportunities with family offices. We've seen over the last 10 years, certain ESOP companies taking advantage of what we call the power of their tax exempt status and their ability to accumulate significant sums of cash on their balance sheet and partnering with the right family office so they can leverage the family office's financial experience to create an investment portfolio of long-term companies. Why? To create significant cash flow to meet their repurchase liability, and also they're good business partners for family offices. So Colin, for the seminar, what is a family office and what is a family office's investment philosophy?
So a family office is generally the corralling of assets that a family has been able to accumulate, primarily through an operating business. And sometimes the operating business still exists, and sometimes the operating business has been monetized, and then the family is left with a large amount of investable assets. And so the family office will help them administer those assets, not just on the deployment or the investing cycle, but also we help with the family's taxes, maybe their insurance needs or various residences. So we really just assist the family that has a lot of resources, work effectively through that.
Jim, what is the difference between a private equity firm and a family office? I know there's a lot of confusion in the world. Is there a difference?
Sure, there is. Fair question. I mean, there are certainly similarities as well. As Colin pointed out, family offices ultimately are about meeting the needs of the family, and particularly that's in the investing arena. And the advantage of the average ultra high net worth family that would have a family office is that they can invest for a very long time period. And they routinely participate in all sorts of investments, not limited to publicly traded securities. And so it's very common to find private equity of all different kinds in a family office portfolio, whether that be through funds or direct minority investments or owning companies, companies other than the company that created the wealth. And that is often referred to as patient capital, because as a general proposition, families are going to last, hopefully have their money last through the generations. And it's about having the assets necessary to meet the cash distribution needs of the family. And beyond that, it's about capital appreciation, preservation, and hopefully growing of the wealth. In that sense, because so often this is done through private equity, it's very similar to a private equity firm. What's different about it is that the family is using mostly, not always, but mostly its own funds. And they're not raising funds from third parties. So there are certainly family offices who do raise funds from third parties. And they don't have the sort of obligations to turn things over in a particular time period. And that's probably the biggest difference between a private equity fund on the one hand and a family investment fund on the other hand is, they don't have a 10-year term or a 9-year term or whatever that term is during which they hope to make acquisitions and then make disposition of those same companies to get capital returns. Families can hold businesses for decades, if not generations.
Thank you, Jim. I've got a question for both of you. Why does it make sense for an ESOP company and for a family office to become business partners? Because that's always a question. Why partner with an ESOP company?
Yeah, I think Jim really touched on, I think the number one issue, which is the alignment, right? I mean, we have two partners with the same time horizon. In this case, they sound they're often longer time horizons than traditional private equity shops. It just creates a better balance because you can build a better, stronger business. You're not necessarily trying to maximize monthly or quarterly distributions to the investors or to the family members. You're trying to build a bigger enterprise, and you can really align with management and build the incentive structure to try to compound the growth over a long time, hopefully decades. And so that's really what we think about is who would be a good partner with us. If somebody wanted to make an investment, they want their money back in 2 years, it's going to be hard for us to build a big durable business in 2 years. And so if we can find a company, and ESOPs are a perfect example of that shared employee ownership structure, and people are in it for the long haul, that's a great partner for us because obviously they know their business, they've created something durable and lasting. So if we can bring in our expertise to help with additional investments, whether it's in the same industry or help diversify the portfolio and look at other investment opportunities that we can share and show to that company.
Yeah, I think that's right. I might add, there's a somewhat unique alignment of interest in that the ESOP company is going to need cash flow over time to meet its repurchase liability obligations, and a family office over time is going to need cash flow to provide to family members for their personal spending and consumption. And so that is an additional alignment factor that makes us think the same way in a lot of ways. I think we really do think the same way. And another advantage is that you can, as a family office, align yourself with some particular industry expertise that you may not have. And oftentimes acquisitions are done through the vehicle or maybe even directly by ESOP companies. And it's a way to grow that expertise that the family may not have. And the family can bring other resources to that relationship as well as money, obviously. So.
And I think, Jim and Colin, you raise a great point as we kind of move into the implementation of how does this really work? There are many successful ESOP companies, and they provide a significant benefit to the employees. And, with the goal, hopefully, the ESOP is a tool that narrows the wealth gap in the U.S. But many of the problems with ESOP companies that result in sales after 5, 10, 12 years is repurchase liability and being able to give equity to the next generation of management. And based on our work together and what the market has shown over the last 10 years, as we reference the diagram, we are seeing family offices partner with ESOP companies, but they're not investing in the ESOP company. They're investing with the ESOP company through an investment vehicle to invest in a group of portfolio companies that are held for a long period of time. So when you think about that structure, you're putting money in along with an ESOP company putting money in to go out and buy a portfolio of long-term companies. What is your investment objectives, and do they match up with an ESOP company?
You ready to go first on this one? A friend of Colin's and mine many years ago coined the phrase about family offices that if you have seen one family office, you've seen one. And so we're going to give sort of generalized answers to these questions. I think the reality is that family offices do align well with this sort of a structure that you see done where you're co-investing with the ESOP to build a portfolio of other companies. It's at a conceptual level, not completely unlike investing in a private equity fund, but instead you're getting the same sorts of benefits of investing in a group of companies over time that diversifies the family's portfolio without having a time limit on it. That you're completely aligned, as we talked about over the time period, with the ESOP company and what the fund puts together within that umbrella. And it's a tremendous advantage. It can be a tremendous advantage because you've got good partners who understand businesses you may not understand, and you may understand businesses you may understand businesses they don't understand. And you're investing for the long haul, knowing that you need to bring cash out and knowing that eventually you're going to want to cash out of the thing with a good capital appreciation.
No, it's a great tie-in. There are a lot of times when, for example, we have products with outside investors, whether it's an outside real estate deal, or not just private equity, but we do a lot of private credit deals, for example, with monthly cash flows. And so, money's fungible. And if the ESOP plan, they need some cash flow and they have investable cash, you can think about the asset liability and matching that, a lot of businesses need to think about. It's like they know they have these payments going out in the future. What are they going to do to time those so they have money coming in at the same time, right? You can do a venture capital investment. You might have a 20x return, but it might be 10 years before that happens. But you need to pay bills and your obligation, your repurchase obligation in the meantime. So being thoughtful about that portfolio and putting those right assets in there to match those liabilities is just paramount to what we do as a family office and what ESOPs need. On the other hand, to Jim's point, maybe the ESOP company has a target that they want to acquire, but maybe they haven't done a lot of M&A, for example. And as family office, we've done this, dozens of times. And so for us, we can sometimes lend expertise to help what you're looking for. And sometimes we have investment products that would match what you're looking for. So it's really a nice combination, but really kind of underlies the fact that we're all in it for the long haul and we don't necessarily have this, really finite time horizon.
Yeah, and I've got another question. When you look at the structure, which is the diagram on the video, you normally see the ESOP company and the family office create an investment vehicle, and they go out and they buy investment one together. And then all of a sudden investment two pops up, but it's a large investment. So maybe the ESOP company and family office A puts in X number of dollars, and there's another family office B that comes in and helps fund it. And I assume that, and then you got investment three. Can you maybe walk through kind of how that works? Because I know as we build out the portfolio company, family offices have friends, they have partners, relationships with other family offices. How does that all work? And at the end of the day, do you think the structure extends the life of the ESOP company? We kind of walk through how you partner up and what does it do for the ESOP?
Yeah, I'll take the first part of that. To Jim's point, John's point rather, being able to invest, in someone's expertise, whether it's your expertise or our expertise, is number one. We're not going to just make an investment super passive and hope it works out. I want to know that Jim knows the plastics industry. I want to know John knows logistics. And so being able to pair up with the best partner, sometimes it's us and sometimes it's you, or sometimes it's another family we know. And so in addition to having additional capital resources, a lot of times family offices, we call them club deals, will club together. And so we can corral a significant amount of capital, but generally there's someone in the mix that has an expertise in that space. And that's probably who we're going to tap to lead the investment or maybe take a board seat, help write the term sheet, set the covenants on some convertible debt we're going to structure with them. And sometimes it's the ESOP company that has that expertise and we have the capital. So we're really just looking for the best partners and then we can figure the money out. As far as extending the life, I think so. I mean, time is afforded when you have the cash coming in from your investment. So either the company's performing extremely well or the investment portfolio is performing extremely well. And that affords you the optionality to make more distributions or continue the enterprise. So I mean, that's the natural outcome, I think, of good cash management.
I think it is, and I think we've all seen this work, and to give the audience a sample, we've seen Investment One be a vessel company that's international, that continues to grow. Investment Two is a waste transition plant. The third one is an environmental company, and there's more and more and more investments that have piled up with this one particular ESOP company. And it's really interesting, Jim, because it's different than private equity, because private equity has limited partners and they go out and they buy a company and then they buy another company. But when they do add-ons, they add on to their portfolio companies and their liquidity horizon is fairly short, I believe.
Yeah, no, you're absolutely right. I mean, it's a general proposition. They're going to want to be in and out in a decade, maybe a little less, maybe a little bit more. And with the ESOP structure and the fact that you're combining not only all that brain power and that ability, you're also combining capital. And that combined capital gives you not only the ability to do more things to create more wealth, ultimately to benefit those ESOP beneficiaries and the family office, but it gives you more flexibility. It gives you the chance to go out a lot longer time period and make decisions that are rational in the context of the businesses you own rather than rational in the context of the clock.
Well, in the portfolio company, is there a sharing of equity with employees of these portfolio companies? Because that's one of the things, in our case, we have Investment One, it's a vessel company, Investment Two, it's a different type, and Three. These employees of these portfolio companies don't share an ESOP. The ESOP continues to get bigger and participate in this growth. But what about the employees in Investment One, Investment Two, Three, Four, Five?
In the family office world, it's customary to include the appropriate employees in the equity upside of a portfolio business that the family has, whether that's direct or whether that's in a structure like this. We would expect it to be the norm. We believe that properly incentivized employees at all levels are going to produce more of long-term wealth than not having properly incentivized employees at all levels. And I think that's generally true in family offices.
And Colin, is there any particular vehicles you like stock options, restricted stock, anything like that, or just cash?
Deal specific. It ends in cash, hopefully, but it's drawn up, whether it's incentive stock options, restricted units, non-qualified. So the structure, I think, for us is less important. It's more the big thing that Jim points out, which is just alignment, top to bottom, in the ownership or in the company structure. You just want to make sure that everybody has the same consistent motives. We all want this enterprise to go well. We want to control expenses and increase profits and hire more employees and add to the communities that we exist in, right? We take a lot of pride in hiring folks and providing medical insurance or retirement plans where they maybe not have had that before. And then to top it off, the equity incentives of they can act and feel like an owner and enjoy the economics from the fruits of the collective effort. So we take a lot of pride in it.
Do you usually see about 10%, 20%? Is there a rule of thumb or is it just deal specific?
I would say deal specific.
Yes.
Maybe earlier stage technology companies, for example, or if you're doing founder-led companies, you'll tend to see higher levels of incentive options because there's so much sweat equity that has to occur. And I would say in a more mature company, you're not going to see that type of size reward. But at the same time, the risk is out of the organization. So the ownership percentage is a little more reliable and consistent. Maybe the dividends are already on, for example. And so I think the stage of the company has a lot to do with the percentage of the equity that is still being passed out, but it happens across the board. The employees are going to be incentivized how, in a more mature company, the employees likely have a higher salary, right? Whereas in early stage, it's all about, can you build this minimum viable product that the market is going to, purchase? So, there's a balance along the way.
Thank you. I'm going to switch gears because this is always in minds of ESOP companies and my guess family offices is governance. So we have this litany of investment 1, 2, 3. So how is this governed? Is it family office control? Is it ESOP control? Is there a meeting of the minds? Jim, give me your thoughts.
It's going to be somewhat deal specific, but I think there's going to be some commonalities no matter what the specifics are. One commonality is that you want good governance. You want the right sorts of expertise sitting at the table making the governance, whether that's at the level of the entity that's making the acquisitions, which is one kind of expertise, or the particular portfolio companies, which may be a different kind of expertise. You want the right, smart, experienced people being there. In terms of control sides of governance, control tends to follow money. And a lot of times, whoever puts in the most money gets the most votes. And that's simple, maybe oversimplified, but that's a theme that you're going to see. But it's going to be collaborative governance at the end of the day. It's not going to be dictatorial governance, or you wouldn't have a partner.
Yeah, there's a couple ways to slice that. Jim's point, not necessarily who puts the most money in, but maybe who has the most value in the transaction.
Yeah.
So for example, if you're making a minority investment in a company, you put in 20% and they have 80, well, obviously they're going to probably have more votes than you. The inverse, maybe the company's in a rescue situation or turnaround, and the new money is mission critical to that company. So there's a little bit of power dynamic involved in that, but that certainly needs to be aligned. And then the character of the investment. I feel differently about equity investments than I do debt investments. Right. And so just like a bank might have coverage ratios or other parameters that they might cap the amount they would put in, sometimes we as a family office can be more dynamic in that maybe we can give outsized terms of senior equity, or maybe we can do like a mezzanine strip, or maybe we're just full on equity. And so each one of those would have different forms of governance from our standpoint. But to the point, we'll figure it out.
Well, thank you. So Colin, the last question, or second to the last question, is what type of resources do family offices bring to the table with an ESOP company buying litany of portfolio companies?
A lot. Short answer is a lot. The family office I work for now was founded from a gentleman who had a leveraged buyout shop, right? And so he had over 4 dozen exits in the private equity space, and that it was across industries, technology, manufacturing, healthcare, and across sector, right? Debt, equity. So with that, creates its own level of competence, but more specifically, you learn those industry pros as you go along the way. And then you're collecting this Rolodex for decades. And so it's pretty rare for us to encounter a company that we don't know something about, or more or better would be to know someone who really knows a lot about it, right? So I don't need to be an expert in any one thing as long as I know a lot of folks that are capable of that space. And so I would say the main thing we bring, of course, is cash. and then network. But beyond that, a lot of M&A experience and deal structuring, whether we're trying to stand up a new facility or start a new business or create a franchise opportunity or build a sales team or marketing team, just the M&A experience. So we've done it. And so that's for us what we need most. And I think the biggest opportunity that when a family office comes into a situation like this is to find our next partner, right? And if that's your ESOP company that's looking for a partner who's capable of doing a lot of things that maybe, you want to focus on your business, but you have these investable dollars that you need to deploy or feel like you want to expand and buy investment one, investment two, but you don't know how to do it or how do we make sure we're not just guessing on this stuff. That's what we like is, you might know people and we know people, and bringing all those resources together. We have a lot of tools in our tool belt to, structure these things and make the best investments we can and invest alongside you. We're not a broker. We're not, trying to make a fee on something like that. You're going to put your money in, we're going to put our money in, and then we're in it together. So that's what we look for. That's the alignment of partners.
Yeah, I agree. The only thing I can think of to add to that is when you look at a family office, the first thing you're going to find is that in terms of the people working there, their number one job reality is they are investors. And a lot of times the ESOP company is going to bring really good operators, but they aren't necessarily experienced investors. And the family office, first and foremost, has got experienced investors in there. That's something I think to add to that.
No, it's a pile on, Jim. So before we were investors, we were operators. And you need to be a good operator before you can be a good allocator, because then you can think about the ownership structure, the right amount of money a company needs. So for us, it's kind of this virtuous cycle of operator, allocator. And sometimes, we take one seat and sometimes we're the other. So.
Well, my last question before we close, Colin, Jim, first of all, thank you for participating in the panel. Is there any question or questions I should have asked you that I didn't ask?
I'm not thinking of one.
These are some good questions, Jim, John. No, I think we about covered it. I mean, everything is, again, deal specific, but more importantly is really finding good partners. And, we plan on being in this in with you with a decade. And so really having that church relationship right is so critical for us, because I've seen a lot of promising investments go south because you didn't have a good partner, and maybe the liquidity situation changes. Maybe there's all kinds of stresses. Maybe the industry macro headwinds move against you. And so being able to be aligned with that partner on the way in, we'll figure out what to do next on this investment. So get the people right. Sometimes the business needs to make a pivot, and we can get behind that. We can put more resources in. We can bring in a new and improved management team. You really just have to have that really good foundational relationship at the top to start with.
Again, I want to thank you for participating in this. And for the participants, this is an interesting concept that is really taken hold with certain ESOP companies where they're using the power of their tax exempt status and their ability to accumulate cash to go out and leverage with family offices to grow a portfolio group of companies that provide cash flow not only for their employees to build wealth, but to create more ownership at portfolio companies. And the family office also benefits because they're investing on a long-term basis. So thank you.
Thank you, John.
Thank you.